Okay, perfect, we're live today, Friday, January 17th, at 7 p.m. Let's kick off our weekly video analysis. I believe this is the third one of the year, or at least the second one in this live format. Just a reminder, those who watch this recording on YouTube will only see the part dedicated to the cyclical analysis. So, let's start by taking a quick look at the calendar for next week. Monday is a public holiday in the United States, Martin Luther King Day. On Tuesday, there's no major news to keep an eye on. The same goes for Wednesday and Thursday, except for oil, which is a recurring topic. That's pretty much it. On Friday, I'd recommend paying attention to two key releases. The first is at 9:45 a.m. US time, which is 3:45 p.m. Italian time, the manufacturing PMI. There's also the services PMI at the same time, 9:45 a.m. US, 3:45 p.m. Italian. Additionally, there's another piece of news, aside from home sales, which, in my opinion, isn't particularly significant. What we really need to focus on is at 10 a.m. US time, so 4 p.m. Italian time, the Michigan inflation expectations for 1 year and 5 years, as this could be quite relevant. In fact, consumer expectations are also sentiment-driven news, reflecting future data expectations. The figure is expected to come in negative compared to previous data, ranging from 2.8 to 3.3. So, keep an eye on Friday, we'll be live, waiting for these updates. Just to note, these releases come after the market opens, so we'll need to stay alert around 4 p.m. Italian time. Alright, let's get started with our video analysis. Let's dive into the charts. We'll begin with the cyclical part. I'll quickly recap what we saw earlier today during the live session. The pattern has triggered, or rather, we've reached the target around the 6,050 area, which was our best case scenario. But more importantly, the breakout above yesterday's daily candle high is a signal of bullish momentum, as it clearly captures the stop losses of the bears, who are positioned above this bearish candle, following this V-shaped pattern, which was a warning sign for the bearish structure. However, this part wasn't exactly something we had prepared for, but we were expecting it, given the 4-day structure. Now, here's the idea, this is a violation of a semi-annual angular trend line. The price has already broken it, and now we're waiting for confirmation of the semi-annual low, which will come when the red quarterly angular trend line turns upward and crosses the blue one. That will confirm a new semi-annual low. The price has already made this breakout, it has already broken the semi-annual angular trend line, so it has already taken out several levels we had identified around the 5,950 area. Sure, there's the news and plenty of other excuses, but the price broke through with volume, leaving a volume gap around 59.50, and it continues to climb. So, the further we move away from the low, the more selling pressure will be needed to reverse the trend. What can we expect next week? Aside from the fact that Monday is a market holiday, so we'll be missing a day, the 20th was a crucial date for the annual pattern. In fact, we've discussed this multiple times in the double way analysis. So, what can I expect for a bearish view? Well, first of all, as I mentioned today during the live session and in previous days, this horizontal level, roughly around 60.50 to 60.60, specifically the high of this candle at 6,068.25 from January 6th, is the maximum level I expect to see retested in terms of a horizontal level. As for a retest of the S&P 500 on this semi-annual horizontal level, and then, if the market is to move lower, what I want to see is aggressive selling pressure on the levels we've just left behind. The first one is 5,950, which needs to be reclaimed very quickly. We're already talking about 100 points down for the S&P 500, but that's not a problem when the market is falling. I mean, it's not a problem when it's rising, let alone when it's dropping 100 points. But then, even more selling pressure is needed. We need to reclaim the 5,800 level below, around 5810, and then accelerate further down to 5750, which, as we anticipated in recent days and weeks, was the level I expected the annual VWAP to reach. The annual VWAP has reached it, but the price hasn't. What I mean is, the annual VWAP has continued its upward trend, hitting the 5750 level, but the price itself is still lagging. So, what I'm seeing is more of a rotation to the upside rather than confirmation for a move to the downside. The first clue has already emerged with this bear pattern at the close of the quarter. The pattern is also visible on the 4-day chart, with a breakout above the semi-annual angular trend line. What's left for the bearish view? Perhaps targeting a lower price level. If we're looking at this from an investing perspective, this horizontal level around 60.50 to 60.60 needs to hold, and then from here, the price should pull back. Now, let's take a look at the smaller cycles to see what we can expect, because despite these attempts by the S&P 500 to push toward these lows, the annual angular trend line has barely moved, and this already hints at a phase of strength in the market. I repeat, I consider the horizontal level at 60.50 to 60.70 as the last line of defense, so to speak, where the S&P 500 is trying to hit today's target of 6,050, with a further extension up to 6,070. Let's move to the smaller time frame, the H1 chart. Let's start by looking at the other signals. What triggered earlier today is the long signal on the monthly structure. This is something we partially anticipated during the live sessions when I said, pay attention to the lack of a downward rotation in the monthly angular trend line, the cyan one, where we expected the structural low on day 4. So, the structural low of the 4-day cycle, expected on January 15th, in practice, the S&P 500 should have pushed toward the lows around 58.10, but this scenario played out in terms of time, not price. Then, the market broke above the 5,950 resistance. We can certainly blame the news, but the market structure was already telling us hours before that this downward rotation. The monthly angular trend line wasn't ideal. There wasn't the ideal rotation of the 16-day angular trend line relative to the monthly trend line at the lower price levels, specifically around 58.10. The lows were missing, so there were already several clues. Here, the monthly pattern low has triggered, and this low confirms the quarterly low, with this bear pattern. So, pay attention. The pattern is the one we hinted at and described last week in the video analysis. I had mentioned it, watch out for the reversal pattern. The reversal pattern has occurred, we're heading toward the target levels. The S&P 500 here is essentially breaking out of the resistance zone, moving outside both the monthly VWAP and the quarterly VWAP. So, what can we expect in the near future? In the coming days? Almost certainly by the end of next week, this type of configuration will develop. Let me change the color, the monthly VWAP approaching the quarterly VWAP and crossing it from below, and this is a key support level based on how the price is behaving, around the 6,000 area. The price is breaking out of the resistance of the 2 VWAPs, retesting, and if buyer absorption kicks in against aggressive sellers here, watch out, because it's very likely will return to the highs. This is the recurring configuration. This is what happens when the S&P 500 breaks through a volumetric resistance area. Typically, it breaks out of a volumetric area, retests it, triggers absorption levels, and then breaks through a key level, like yesterday's daily candle high, breakout and acceleration. The S&P 500 is breaking out of a key resistance level, and the next likely configuration is that this level becomes a multi-day support from a volumetric perspective, with the monthly VWAP crossing above the quarterly VWAP. This is already the setup for next week. Let's move to the 5-minute chart with the smaller cycles, from the 16-day to the 4-day. Let me center the chart. We have an 8-day low and a 16-day low, so we're already at an 8-day top. Earlier today, during the live session, I told you, pay attention, we're heading into a cyclical top, entering the day sequence of the 4-day cycle. The upper volumetric resistances around 6,050 are the target. The 4-day cycle structure is already distorted because the low here was missed. So, a new structure has started, which would be this one. It made the high here. In reality, we're in a time 3 cyclical structure. Everything is distorted now because even the first structure of the 4-day cycle is deformed, as it was a time 3 structure. So, it's normal now for the cyclical waves to appear short, as it's rotating 3, plus 3, and plus 3, to complete the entire 8-day cycle closure. Therefore, pay attention, as I mentioned today during the live session, these extensions are an intraday target at 60.50. There's no need to necessarily aim for 60.70. It could happen, but statistically, it's risky, and for now, it's not doing it. It has done what was much more likely, breaking yesterday's high and reaching the volumetric target. We'll see it soon, around 60.50, with the 8-day top still forming. So, be cautious with this extension now, because statistically, the ideal cyclical configurations are no longer present. Why? This is the top of the 8-day cycle, and here we have the sub-cycle waves, 4, plus 4, plus 4. So, pay attention, we're likely looking at a time 3 structure within the 4-day cycle, with the 8-day cycle closing. Therefore, what's missing? The upward crossover of the 4-day cycle over the 8-day cycle. What's the most logical level to expect in this configuration? Let's look at the behavior of the 8-day VWAP and the 16-day VWAP. They're crossing upward. So, this is a new configuration of a resistance area. What's the first support level to watch? The 8-day VWAP. Let's zoom in. Let me turn off the drawing mode. Here it is, orange, 59.48. But this is a level we're not discovering today, as we've already discussed it during the 2:30 p.m. live session. It's the key level at 59.50, where the volume profile gaps were created during the January 15th news. And most importantly, it was a key technical price level for the entire structure. Let's revisit it. Here it is. This was it. So, as I mentioned during the live sessions, it's clear that where congestion forms and then breaks occur, creating volume gaps, that's where indicators like the VWAP, which is a price-to-volume ratio indicator, converge, identifying key levels. Therefore, from the perspective of the 16-day cycle, what would be the target level for the low? This zone around 59.50. So, I repeat, I don't expect the closure of this 8-day cycle to generate a low below here. It's unlikely, given how the S&P 500 is behaving. Instead, it's much more likely that we'll see much higher support levels here, just below 6,000. So, the S&P 500 could rotate here next week, form the low of the 8-day cycle, bounce, and then complete the closure of the 16-day cycle, which is below here, in magenta, which will happen when the next 8-day cycle closes. I expect it to reclaim this level, which now remains the key support, but I repeat, not now, rather, with the next closure, meaning the closure of the next 8-day cycle and, consequently, the 16-day structure. So, the S&P 500 will likely reclaim this support area, which will then become increasingly evident as the spread between the two VWAPs widens, clearly defining the support level, which will be between 59.50 and 59.70. Pay attention, this is a support area because, as we'll now examine from a volumetric perspective, remember that there's a volume gap here. We practically witnessed it live as it was forming on the 15th, okay, during the news, a volume gap. Even though this is the bearish view, what I expect is not for the S&P 500 to crash to 5,950 or below immediately on Tuesday. Instead, what I expect is that the S&P 500, at the closure of the 16-day cycle, will return here, become unbalanced, attempt to enter the volume gap, and suddenly get rejected, then bounce upward, confirming the already ongoing bullish structure of the quarter. We're still waiting for confirmation of the semi-annual level, as I showed you earlier, so we're missing the breakout above the horizontal resistance level, the semi-annual one, which is at 6,070 or 6,080. That's what I expect. Naturally, by the end of next week, and perhaps even closer to the month's close, we'll need to pay close attention when the S&P wink with tongue sticking out 500 approaches this time-based closure, so not so much the 8-day cycle, but rather the 16-day cycle. Watch the support levels, especially 59.50. Those looking to take short positions shouldn't enter too late. If you need to take risks, take them when the S&P wink with tongue sticking out 500 attempts to break the 60-70 level, because, from a logical standpoint, that's the least risky point, as we're dealing with a semi-annual horizontal resistance. When it returns here, be cautious, because we're entering a danger zone. It might seem counterintuitive, but we could be entering a danger zone because there's a volume gap here, and suddenly, if volume is lacking and buyer absorption kicks in, watch out, there's a risk of an upward acceleration. We'll obviously discuss all of this in detail during the live sessions in the coming weeks. Now, let's look at the 4-day pattern. Here it is, let's center the chart quickly so we can analyze it. I'll repeat what I mentioned earlier about this 4-day cycle structure, which we've been building in real time over the past few days, and where I had indicated my ABC structure with a low here, but the low didn't materialize. Instead, the S&P wink with tongue sticking out 500 made a structural breakout on the 4-day chart. What did I do? I shifted the entire sequence, the entire structure of the new 4-day cycle. I moved it practically starting from this zone of the new low. In fact, I placed the BC structure here, clearly positioning point C here, but this isn't the actual point C, it's further ahead in time, as we're still missing some time. I've already positioned 1, 2, and 3, the first sequence of day 1, and days 3, 4, 5 as the sequence of day 2. I told you, pay attention, day 2 is closing. We'll already be in area 3, so this zone is the target. There's no need to go further. In yesterday's live session, I talked about a potential sideways area as the expectation for the day, based on the absorption levels we saw on the depth of market chart. So, the market confirmed our view, high probabilities of a sideways session, a bullish sideways move, and waiting for intraday support levels to look for long opportunities. Today, sequence 5, 6, 7. And as I mentioned, if from here to here on the lows, it's about 24 hours, and looking at the vertical lines, from here to here is another 24 hours, and from here to here another 24, we're in a day where the low is missing. So, pay attention, it's still 7:20 p.m., and until the session closes, we could see a quick recovery of the levels left behind, especially the high of 0.4, which is clearly yesterday's high. This level could be quickly reclaimed, rebalanced, and then proceed to form structure 7, 8, 9. There's no need to remind you that structure 7, 8, 9 will occur on Monday, when the US market is closed, so we're missing a day. A new acceleration, either upward or downward, will then show us what the market has to offer starting Tuesday. But the fact is, structure 7, 8, 9 happens on Monday, so I'm referring to it as the final swing or what should be the final part of this ABC sequence. Well, with that said, it's been about 21 minutes since the start of this recording. I'll wrap up the cyclical part here. All of this will be uploaded to YouTube tomorrow, and now we can move on to the volume-related section.